Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Chris Bates, welcome to this episode of the podcast, mate.
Hi, Owen. Good to be here as always, mate. How's happy Friday as well? We're recording some Friday morning. So how's the week been?
It's been all right. You know, I try and do these things that I learned through my footy coach, which is a GBB. What went good, what could have been done better, and what was bad. GBB, do it every week. And for business, I think this would be one that skews to the bad, but I'm trying to be positive about the future. So that's where I'm at. How's your week been?
It's a roller coaster of business, isn't it? You know, it can be almost on a weekly cycle, but then it can also be on a daily cycle and even an hourly or minute cycle sometimes in business. It's the emotions of it all. Sometimes you just got to ride it, don't you? It's and know that the better times are around the corner, and that's the fun of it as well.
It is, yeah, it is. And you count the good days, and normally they outweigh the bad days. But sometimes you have bad weeks. In much the same, you know, if you're managing money or you're investing in property, it doesn't always go up, even though we might think it does. And we'll talk about that today. We're going to talk about Perth's property prices. We're going to talk about why property prices go up. We've got a lot of questions. We'll talk about refinancing and the importance of refinancing, in my opinion, not super regularly, but regularly enough that you're getting good deals and you're really being proactive. But obviously you and I are quite close, and you do the property podcast with Pete every week, and Amy, I should say. But for folks that are listening on our Australian Investors podcast or the Australian Finance podcast, although you appear regularly as our property and mortgage broking expert, they may have missed the episode which we covered where your business, Blusk, merged and became one of the biggest mortgage broking businesses in the country, which is now called Flint Group. Two questions is, tell us a bit about that, if you can. And the second is, like, where are we at? How's it going?
Yeah, so we started in February. It was about 6 months before that, sort of planning on doing it, but it all got rushed a bit in the end. That we probably wanted to launch it in the middle of this year. We had to rush and launch it in Feb because the cat got out of the bag that we were doing it. Ultimately the bigger motivation is to be able to help more people. And, you know, the broking industry is going through this digitalization of mortgages, and we want to be at the forefront of that. So, and you need capital, you need money to invest in your processes, your tech, and also our team. We yes, we want to help more clients around the country, and have a bigger and bigger impact over the next couple of decades. But also we wanted to help more families in our team, also achieve what they want to do, and more people be part of this venture. And there's a team of over 50 now, so 50 people who've got husbands and wives and kids and partners, and so I feel like we're doing a good job there, and helping them, but also we're helping 100 plus families a month sort of do something towards property, and so it's going really well. I mean, a merger's got way more challenges than I thought. Merging teams together and tech and processes and different values, and we've also got like an offer. I've got a big, lesson, I guess, in legal and tax and structures for our brokers, etc. So, but bit by bit, we're getting flow back. I think, like you were mentioning there in business, what you really want to do is just wake up and have your day all set out and do all the stuff that you want to do that you really love doing. And that for me is a lot of client stuff, if I'm honest. The business stuff I love, but I also like to, mix it with a lot of face-to-face client stuff. So I'm backing more and more on the tools, talking to our clients and getting a real good litmus test on the market, because we do have a big variety of people doing lots of things. So that's one of the benefits as well now, that I get to see what all our brokers and Christian and everyone's, and what all their clients are doing as well. So yeah, it's been a big 4 or 5 months, and it's still a lot of work to do.
When you made the announcement with Christian and Ben and the team and everyone at Flint, it was like all over the mortgage broking magazines and websites and finance websites and all this stuff, because it's a big deal, being two of the most recognizable brokers in Australia joining forces, and then all the mortgage brokers seeing that and then wanting to kind of coalesce around you and be part of it, which is really cool. Can you, for anyone that's listening to this, that is like thinking, mortgage broker v bank, and you said digitization, some people think they can get like that pre-approval thing through banks now. Can you talk a little bit about the benefits of using a broker as opposed to going direct to a bank?
Yeah, I mean, there's lots to it. I mean, ultimately, if you could go in the bank and get given great advice and get given choice and speed and everything you'd want, then that competition between a bank and a broker wouldn't be there. But banks are very limited in what they can do, right? And brokers aren't limited. We've got choice of the market. We run our own business. We're not tied to any bank at all. We can go where the best rate is. We can be there as a long-term relationship generally, because a lot of brokers are one-man bands or small business owners rather than bigger businesses. So you get this real stable relationship. You don't pay a fee for a broker because broker market share is now 75%. It was 40 when I started back in 2013. The reason you don't pay a fee is because we introduce a lot of customers to new banks. So you might have done all your stuff in your banking at CBA, and then you go to a broker and you set up a home loan at ING, right? So that's ING haven't done any work, but they've now got a new customer and a mortgage on their books. And that's why they pay brokers. They also pay brokers ongoing to keep them on the books. But then brokers say, well, if you're not looking after them, we can refinance them elsewhere. So, I mean, our secret sauce, and it's something that we've brought from Blusk into Flint, is our strategy team, right? Ultimately, a lot of broking businesses is built around, getting you a bank product and getting you that, delivering that in a nice customer experience. But we don't think that's enough. We think that the next evolution of the broking industry is really becoming trusted advisors. And it's the reason we look at it this way is we've come from financial advice, and Ben, my business partners, come from financial advice as well, and the paraplanning side of it. And so we try to bring the long-term life planning, financial advice philosophy around thinking through your decisions and different scenarios and trying to optimize your decision into mortgage strategy, and then giving you a detailed strategy document that will talk through those different scenarios, because that's really valuable. And then once you figure out what's the right next move for you, do we buy, do we sell, do we upgrade, do we renovate? Then it's a case of that's what we do. Who's going to be able to give us that loan? Not just at the best rate, but structure it the best way. Give us the best buffers. Help us be in the best position if we want to make the next decision after that. And so that's different to our brokers. So we split it up. All our strategy team, we hired a new girl called Alice 2 weeks ago. She's a chartered accountant from Bentley's in Brisbane. Kat was a corporate accountant. Piyush was an accountant. Ben and John came from paraplanning financial advice. So we really try to build an expertise in that team from a strategy point of view. And not many brokerages around the country because they haven't come into broking from that financial advice background.
Yeah, that makes so much sense. So one of the things that you, Pete, and I did probably about 2 months ago now was we did a live show, and it's still available on YouTube and it's still racking up the views. We did a session which we've been planning for a few weeks prior to that, which was 47 reasons why property prices will keep going higher. And it was kind of us digging our heels in against all of the doomsayer news headlines that everyone in every newspaper and the TV and social media seems to just perpetuate. And I'm going to call out Perth's property prices in a moment. But I'll put the link in the show notes for folks that want to go back and watch the actual YouTube live, because it was super valuable and there's a little PDF to go with it. How do you weigh this up? How do you weigh up, if we come out and say, hey, property prices will keep, there's reasons why property prices will keep going higher, but everyone else in the media, Chris, is obsessed with saying property prices are about to fall. We're on the precipice. This is the new thing. How do you think about that trade-off?
Look, I think the property market is different to other asset classes. So, some other asset classes you would say they're overvalued or undervalued because it's just purely investors playing in there. Investors are rational, but even though they're not. But in the property market, it's driven by owner-occupiers and home buyers, right? So there's this need to live somewhere, right? And when you look at property, it's all the fundamentals are pushing in the wrong way for pushing house prices down, right? We're living in our houses longer and longer. It's harder and harder to upgrade. So what that means is because the jumps are bigger and, it's more expensive. The housing markets run much faster than the apartment market. The bigger houses have grown faster than the smaller houses. And so, yes, if you look at long-term listings, like go back, type in SQM, there's some beautiful data there on listings long-term. And you can see like a decade ago, there was 400,000 listings on the market. Now it's 200,000, right? So like, it's about 50% down. That means that 50% less people are selling. That's our supply is getting tighter, even though our population's much higher. And our needs for housing are much greater than they were, 10 years ago. Like we're living longer. So that means we're also not selling, aged care crisis. You've got a lot of investors not entering the market. So then there's a rental crisis, which is forcing people to want to own because they need that security and stability. And our rental market's just structured the wrong way. You can only get short-term leases. You can't get long-term leases. We've got an economy that's built on, that's addicted to immigration, right? And, so we need to keep people moving here to keep pumping up our economy, whether it's our tourism or our education or et cetera. So we've just got a natural desire for wealth around the world. We're just a very desirable country if you're doing well around the world to invest in Australia and move to Australia. We've got more millionaires moving here than a lot of places around the world. So, look, there's a lot of, I can go on and on. So there's a lot of fundamentals that are pushing prices to home ownership. You got a whole banking system structured around property and the government addicted to property taxes. And you can see that just only increasing that. And we've also built this system. It's hard to unwind the system and move to an entrepreneurial society when everyone's tied up in debt. So it's very hard to get off this system. So that would be my overall, but it doesn't mean in the short term you can't get booms and busts. You can't get when credit's really easy, credit's really cheap, and credit's really hard, and credit's expensive, or you can't borrow as much, or there's an economic shock or a fear. So it doesn't mean you're not going to get volatility, but the property market's also buffered a little bit. It's got a little bit, when times are tough, people naturally sit on their hands. So it's got this like shock absorber. So when, there's fear in the market, you don't just rush to sell. What you do is you sit on your hands and it ties up supply. And so, and that actually supports prices because there's less people selling. So even if demand drops, that's usually offset by, supply dropping as well. And so, there's lots to that question, Owen, but, we could do another 5-hour session on it.
Well, we did that whole hour and we didn't even get anywhere near the 47. So I'll put the link in. People like it. If you are listening to or watching this, and you read one of those things in the news that are like property prices forecast to, don't even bother finishing the headline unless you actually understand why that person would be making that call. I remember during COVID, I did an episode where CBA economists had forecast a 32% fall. And the reality is that was probably just one of the scenarios that CBA had in its vast, like, if COVID this, then that kind of thing. And the media just jumped on it and thought that would be great. And then we pin these people up in the media that are constantly saying how bad things are. And, they're the people that get all the news headlines. But that session we did was really valuable. And you mentioned it there, like if we just think about very basic economics, like economics 101, like supply and demand, fewer houses with more people, like think about the way that prices would react in that scenario. Fewer places to live and more people wanting those places to live. It would make a lot of sense that prices go up. And unless something changes, we did a little session recently, Chris, just about like economics 101 and microeconomics being like, most people know supply and demand is the key principle. And that's it in action right there. Now, speaking of like things happening in the property market, so I pulled up the latest data from CoreLogic. I got it last night and we're recording this in July, but we got the data, obviously it's on a monthly basis. We got it to the end of June 2024. So like the financial year. Overall in Australia, prices, according to their data, went up 8%, which is amazing when you consider in the last few years how interest rates have gone up and people were saying how bad it was. Now, Canberra 2.2, Darwin 2.4, Hobart slightly negative, Sydney 6% positive, Melbourne up 1.3%, Brisbane 15% or 16%, Adelaide 15%. But this is the one I want to talk to you about. Perth, 23.6% in 12 months, Chris. Are you surprised by that? And then the following question is that kind of thing sustainable?
Look, it's doing that in a market when interest rates are high and it is tight. Look, I think there was a lot of pent-up demand in the Perth market that there was no rush to upgrade, right? Because prices were falling. There was just never that pressure cooker. So people would upgrade when they need to upgrade. They didn't see the financial benefit in a bigger mortgage because there was no tax-free growth in the return. So they, sometimes that's what pushes prices up, right? It's that FOMO, it's that ability to the financial return, it's that speculation in the market, etc. And so in this, when Perth has finally got that FOMO's kicked in and people, plus it's got a lot of interstate investors, a lot of investors haven't got the budgets to enter into the capital cities on the East Coast. Money's really tight. And there's been a lot of media, property people that have talked up Perth. They've been talking up Perth even before it boomed, to be honest. And so it's also, and Brisbane was like that as well. If you go back to 2014, 15, 16, everyone was like, Brisbane's the next place to boom, it's the next place to boom, next boom, right? And so I think my worry with Perth a little bit is just you are seeing some areas that are going to be driven by long-term wealth creation in Perth and by the aspirational home buyer and the interstate person moving there, migration, maybe they're moving there for job opportunities. And Perth has got a little bit of a, when the resource sector is doing really well, there is money flowing around. When that sector does tank, and it does, you can just go back in time, the confidence in the city really collapses, right? And so it has naturally got a much more bigger boom and bust cycle just because of the way that the economy runs so heavily linked to the resource sector, right? And so you've just got to be careful. If that party stops, and I'm not saying it will, and I'm not saying it won't, but at some point, resources go out of favor. They just literally, the volatility in their prices changes and the profitability of projects, and if projects aren't profitable, then they're not doing capital investment, and then that's not creating jobs, etc. So it just goes in these cycles. So just be wary of that in Perth. But ultimately, there's a handbrake on the economy over there still. Interest rates are high. It's a national interest rate. Borrowing capacity is national. So if borrowing capacity goes up and interest rates go up and the confidence in the Perth economy with employment stays there, who's to say it hasn't still got legs? But I would just say if I was buying assets over there, I'd want to buy assets that would weather the storm when the tide turns, right? The famous Buffett quote, right? So when the party's over, right, there's going to be a similar situation to what happened in Perth for 10, 15 years before the boom, where prices didn't do much and there was basically a bit of sting came out of it, right? And there's naturally a top in investment cycles. And so what you want to just really do is if the market turns, and it can turn fast, it can turn in days, right? Bad news can really flip sentiment. You just want to make sure you don't own properties where the price has been pushed up by investors. And then if the investors then try to take their money and run, you'll naturally see a market go from undersupplied to oversupplied. Because if it's been driven by investors, it's not driven by locals, and locals can't afford it. If investors aren't going there and investors are selling, then all of a sudden that repricing will come back down. So my view is if you're doing in those investor hotspots, it's always about the, oh my God, I've just forgot it. It's the greater fool theory, right? So you've just got to get out before the party stops. If you're buying into the housing market and the aspirational housing market there, and it's a long-term investment for you, then you should be okay, because those natural markets will have a bit of a shock absorber to them. And that's driven by the locals. So that would be my Perth synopsis. Party's over, but you just want to be careful. If you are gonna try to take some money there and run, don't hold on too late. Don't get too greedy. That would be my call.
Yeah, because leverage can, using loans and leverage can backfire on people, particularly when things turn south. And I think that's one of the things. There's so many biases that play out when I bring up 12 months of property prices. Yeah, 12 months seems like a long time ago. We were talking in 2023 about property. But the reality is, when it comes to investing in property, that ain't a long time ago. When we talk about property, and you talk about this all the time, Chris, and Pete does it too, is this is a long-term asset. this is a thing that it costs you a lot of money to get in, it costs you a lot of money to get out. There's holding costs in between. You treat this as a long-term asset. Like Pete's approach is often like he's maybe a little bit more extreme than me. He's kind of like buy and never sell. But what you've always taught me is that buy quality, and even though it might cost you a little bit more to buy a good asset, like a good house or in a good street, the right facing block, family home, whatever, is that when you might pay a little bit more, whatever, your price might not go up as quickly in the short term, but when the market turns, you've still got one of the best assets on the street or in the area or in the right neighborhood, and that might not fall as far, which then gives you comfort in that period. And those things become more valuable even throughout the cycle. So that's great to know. And I'm sure like if people want more commentary on like property prices and areas and suburbs, the Australian Property Podcast is definitely the place to go. It's really growing fast, the podcast series. But I want to move on because time is, say, limited today. You just
made a really good point there, Owen. I just want to double click on that. While we're talking about the property market, just be really careful. The Australian property market's not a market. It's not the Sydney property market. When we buy property, we buy one of the 11 million properties out there. And that really matters. The street, the house versus apartment, the north versus the south, the better floor plan, the better, a flat block versus a steep block, a square block, a rectangle block versus a triangle block, privacy issues, it goes on and on and on. And all those 1% add up. And you've really got to focus not just at a macro level and a city level and then a suburb, but then you actually then have to get into the weeds and then try to pick a property within that suburb that is on the upper echelon and something that's super desirable for locals, but also it's desirable for new people moving to the suburb. And so I just want to always, double click on that because people sometimes just get wrapped up too much in market commentary when that's not really what you buy.
Oh, same. It doesn't matter if it's shares, property, Bitcoin. People always just read the headlines and think that applies to me and not necessarily the case. The difference with property is that your property is different to mine. We're both in the quote unquote Australian market. You live in Sydney though. I live in Melbourne. We live in totally different areas and totally different assets. Whereas if you go and buy BHP shares and I go and buy BHP shares, they're exactly the same. So there's no uniqueness about that. So that at the end of the day is very, very different in terms of how we think about things. I want to cover off on something really quickly because I know a lot of our community is really thinking about refinancing at the moment. There's a lot of people that listen to this that are thinking, well, property prices are up, sure, my interest rate's up. I've probably got equity in my home. Pete always talks about it, that, using leverage responsibly, particularly when you're PAYG or you've got a consistent income, is like a superpower in that you can grow your wealth faster over 5, 10, 20 years if you prudently make the use of your mortgage and your financing. And I came on the air a few months ago with you and we talked about should I use the equity in our home to buy a farm, which is like my long-term aspiration. Still haven't got to the farm yet, ladies and gents, but it was probably one of the most popular episodes we've ever done. And we're at the point here now where we've just clicked over the tax year. And I said to you yesterday, I'm going to do my tax return. I need to get this sorted ASAP. Can you talk to us about the idea of refinancing? What is it? What's the process?
Look, it absolutely should just be a part of your financial toolkit, right? Or your financial sort of cadence or rhythm, right? Constantly check your insurances, right? Constantly check your super to make sure you can maximize your contributions and your fees are good, etc. So it's just part of sort of financial 101, right? And so what you technically should be doing, and I reckon frustratingly, is probably every 12 months, I would say. You really probably want to be on your home loan. If you start getting longer than that, just in terms of the way that banks do pricing, is that there's this thing called loyalty tax. There's a bit of a government even looking at this, right? They've been writing some reports on this because what banks do, like a lot of, whether it's your phone or your electricity, etc., there's this loyalty tax, right? And what they offer is better prices for new customers than they do for you as existing customers. It just doesn't make business sense in my view, but ultimately it's the way the banks are making bigger profits is they're playing on your apathy, you're playing on your laziness to check your mortgage, right? And so you have to be looking at it every 6 to 12 months just to make sure you in the best rate in the market. Now, in the last few years, that loyalty tax blew out like next level. There's a mortgage wars. It was all in the papers that banks were writing loans under the cost of finance. It has actually cooled off a little bit. So pricing this year isn't as good as last year. So, a lot of people are on better deals than they were, than they can get today. So that's good, right? But that doesn't mean they shouldn't refinance, right? They should potentially look at their loan and go, well, have I built any equity in this place? At the moment, you might be surprised. Some places have done really well, some places haven't. And could I get access to that equity? Now, I could use that equity to invest. I could use it to renovate. I could just leave it there as a buffer. Who knows what's around the corner, whether it's a job loss or an opportunity pops up. So having access to liquidity is always good. It's whether you're employed or whether you're running your own business. So that's the first thing. So rate, definitely getting access to equity is always good because you might not be able to get access to in the future. Valuations could fall, something could change to your job, bank policy can change. The next thing is just another way to build buffers is extending your loan terms. Now, some people would say, oh, that means I'm going to pay more interest to the bank. Well, it is if you're going to pay it off on their terms and you're going to pay a payment is. But really, when you're paying your mortgage off, what you should be saving each month is the maximum you can out of your income. And what the bank tells you to pay really should be the absolute minimum you should be saving, right? And so what you need to be doing is looking at your personal finances and going, I've got X amount of income per month. We need so-and-so to, live each month. Let's say we get 10 grand, we need 4 grand to live. Let's save 6 grand a month. Now, if your mortgage repayment's 3 grand a month, well, that's great. You're way over the minimum. And I think that's how you should be approaching your mortgage, and you put that in the offset account. So extending loan terms, releasing buffers, making sure you're on the optimal rate, and setting yourself up for your next decision. So sometimes that next decision's now, or you might say, oh, my next decision is buying an investment property. Okay, well, should I do it now? Or maybe not. Equity's not enough. Borrowing capacity is not enough. It's too risky. I can't get a good asset. Let's come back in 12 months. And then we do it again, right? Or if resi exposure, I can't see us buying another investment property. Maybe we should just release some equity and dollar cost average into the investment markets, right? And build a share portfolio while we're still paying off our home. And so they're the reasons you should be looking at refinancing. It's a structural thing. It's not so much just, hey, can I get a better deal? Yes or no? Okay, I'm not going to refinance. You're missing a lot of other benefits of refinancing.
Yeah, I was thinking about this in today's episode, and because I was thinking about what are the common reasons that people would refinance, and of course, get a better rate. You mentioned it there. Sure, that's a lot of people want a better rate, and fair enough. The mortgage is often the number one stressor and the biggest bill everyone pays every month. But I was thinking about the common reasons, and then I was thinking all of these things actually could apply to me. For example, if I redraw some equity from my house, I could do some renos. I'm thinking maybe I put on a double car garage that might add some value, but also be super beneficial for me. The car just sits out under the gum trees and just collects sap at the moment, so that sucks. The other thing is I could use that money and then invest in ETFs, and hopefully that interest is tax deductible and I get franking credits and I grow my wealth. Then I was thinking maybe I could just redraw some money if we were going to have kids, and have that sitting in my offset account. So if we go down to one wage for 6 months, I feel like, you know what? I don't need to stress about having one wage for the next 6 months. I've got a bigger buffer. That's super important to an early family. Then the other thing that was applying to me, which I'm thinking a lot of people do too, is investing in my business or businesses, taking that money and then maybe I could make a loan to the business, or maybe we could put more money in the business to fuel its growth. And then in 3 or 4 years, you extract that through a dividend or loan repayment or whatever the case may be. Now, obviously, you need an expert to help you with some of those things. But for me, Chris, I was I could literally do all of these things. So what the hell am I doing? I've got many years to work and to grow my wealth. Why aren't I maximizing and moving towards that now? So I don't know if you have any comments on those things, but those are some of the things I've been seeing around me with people doing recently. And I was we should tell everyone some of the things you could do.
Yeah, it's an interesting one. So you think about that, right? So the garage is an interesting one there, right? So if I can release a little bit of equity and add value to my place, am I going to, and it's hard in this market because reno is expensive. So unless you got, family in the building game, which I've had heaps of clients in that space where you think, hang on a sec, they're doing a $300,000 reno for 50K. Someone's doing some labor for free. But, if you could do that, Owen, right? Let's say you do your garage for 50 grand, but it adds 100 grand. Just think about the economics of this. So your val goes from, it's just to round numbers, goes from $1 million to 1.1 million. So you've now built 100 grand more equity. You can take 80% of that out, 80 grand, but the garage only costs you 50 grand. Yes, you'd have to pay interest on the 50 grand, which would be, let's say 3 grand a year, but you would have 30 grand more in your hand because you've just spent 50, right? So that's more than going to cover your interest. And you're going to have some type of lifestyle benefit from the garage, right? So your Tesla's no longer going to be looking spotty. And so that would be the first thing there. So I'd go, look, could I do that efficiently? Then get my 80K out, right? Which would probably only be another 30K because I've spent 50 on the garage, right? And then maybe I could buy some shares with that, right? So I can have my cake and eat it too, right? And so I've upgraded my house. If I ever sold my house, it'd be more desirable to sell. So that's one of the benefits of doing renovations because life plan changes. We're going to live here forever. And then I speak to a client a year later. Oh, no, we're moving, right? And so people's plans change. And so, if you ever wanted to sell your place, would it be much easier to sell with a double garage than a place without a garage? And that's another, yes, you can get a better price, but is it easier to sell? So, yeah. And, putting money into the business, that's a definitely banks won't really want to lend for those reasons in fairness. They get very nervous. And this just goes back to my earlier points around just the mentality of the banks, like totally happy to leverage up to 80, 90, 95% into residential property, start a business and want to borrow in a business. Oh, no, we're not going to support you there. That's too risky, right? And so, yeah, you've got to be a bit careful with how you approach that one. But yeah, buying shares, great option, right? Like, because you said that the interest is tax deductible if you buy investments with it. Yeah, you've got the income from those shares, which you have to declare on your tax return, but it's like negative gearing property. You can negative gear shares, right? And, if you buy those shares and hold them long term, the after-tax cost of holding those, should be returned in capital growth over the longer term, but it can be very, different in short cycles. Yeah, they're really good points.
Yeah. So we've got a couple of questions that I want to get to in just a moment. Do I need, this is just a quick one. If I'm someone who got a property, maybe like a first home buyer in the last few years, and I've got a guarantor on my loan, assuming that, well, I'll let you explain it, but do I need to do a formal refinancing in order to remove a guarantor?
Look, it does depend, and it does depend sometimes where the banks are in cycles and credit policies, and sometimes they're able to make changes to loans with very limited assessment, and sometimes they are very conservative and they'll ask you to go through a full application and make sure you can service the loan. It does change for banks. It's one of those quirks, but ultimately what they really want to do is just make sure, can you afford the mortgage still? A lot of banks will do the servicing thing. It just is a way to protect themselves, right? And what they'll also want to do is evaluation on the property. But if you can service it and you can have a bit of equity in the property, then you're probably best to get rid of the guarantor. The guarantor is there for not forever. It's there to help you enter the market, help you avoid mortgage insurance, potentially allow you to spend a little bit more money to get a better asset, or maybe spend some money on some renos, etc., or have a buffer. And when you're getting into that family stage, you're not super stressing about the mortgage. But once you've had those benefits, I do think getting rid of it, even if your parents say they don't want to, I just think it allows them to have a bit more, access to their cash if they ever needed it. And you just never know when your situation could change. You could lose your job, prices of properties could fall, etc. So, and sometimes you can get yourself a slightly better rate as well by getting off a guarantor, because now you're under 80%. And you can shop the market a little bit better versus when you've got a guarantor loan, you are restricted in terms of the lenders. And yeah, so I would definitely look to do it, Owen, if you can, because, I think it's nice to just return the favor and go, thanks so much. You really helped us and we've got rid of it, and they can just rest at night knowing that it's off their books.
Yeah, that makes a big difference to a lot of parents out there too, I'm sure, because if they have plans with their life, maybe they want to sell their house, or maybe they want to do something that their child's loan is secured against. So if I was to do a refinance right now, like I am literally going through this process, about to go through it with Ben. If I was to go through this process, I would prepare myself as if I was preparing myself as in the bank's going to do an assessment on me, and the property. So they're going to get a valuation on the house. They're going to send someone out. They're going to maybe take a few photos, have a look, and be like, "Yep, okay, based on recent sales, whatever you've done to the house, X." Bank gets comfortable with that. Yeah, you got some equity in your home. Then they go, okay, now let's do the assessment of your financials. So they want pay slips, debts, expenses, like the usual stuff, right?
Yeah, I mean, the valuation, when you're doing refinances, it depends on whether you're just looking for a like-for-like refinance. I don't really want the buffer. I'm not that bothered. I've got heaps of equity. I just want a better deal on my mortgage, right? So then the val doesn't matter that much because the loan's well under 80% LVR, and we just go whoever's going to give you the good rate. You're a bit different though. Like, obviously we're trying to get some equity out. And so when we do valuation, banks will all value it at different prices. Rather than when you purchase a property, they'll all just value it at what you purchase it for, right? Because even if you've got a good deal, they're just going to value it at what you purchase it for. They won't use it. And even if they think you maybe overpaid a little bit, they'll just value what you purchase it at. They're not too obsessed. But when you're refinancing, absolutely. They're usually more conservative. Sometimes they do full vals. They go and look at the property and take photos. Sometimes they do desktop vals, like kind of automated vals, sort of online, etc. So we sometimes have to play the banks a little bit at this game, and we'd like to do 2 or 3 valuations at different banks. One will come in at $1 million, one will come at $950, one might come in at $1,050,000. And we go sometimes where you're going to get a great rate, but also maybe where it's giving you the best valuation if equity matters a lot. So we'd play that game first. Then we realize, okay, everyone's coming in at the similar price. Let's just go where the best rate is and where you're going to qualify, because every bank's got their own lending policy. Some, being self-employed, they might look at the last 12 months of business. Some might look at an average of the last 2 years or the lower of those years, or some might just look at your pay slips and salary now. That's a bit of a quirk in recent years where they look less on the business profits, but more what you're paying yourself, each week or month. So yeah, we'll play that game. We'll figure out who's going to, make happy to lend you the money at a good rate, structure it the right way. And then what we'd do is we would lodge it, get formal approval. We wouldn't lodge it unless we knew it would get approved. Like that's a really early day broker thing. You sometimes play a bit of mud on the wall because you just don't know what you don't know. Our team would, always, if there's any issues, we'd check it with our BDM and our state manager if we have to. We'd lodge the loan. 99.9 times out of 100 will get approved, right? We wouldn't have lodged it anyway. It goes through, it might take a week, it might take 2 weeks, might take 3 weeks. Usually at the moment it's a bit faster. And you get formal approval, you get some loan docs. Now it's nice, they're all digital. You sign them on DocuSign. And then they would try to book in a settlement date. And so they would say, like on the 1st of August, this thing's going to go through. And then they would pay out your property loan on that day. You would set up a new loan at the new bank on that day. It's not something you need to do. It's online software called PEXA that it all happens through. And then that money would be released to you on that day. You then have to set up your new internet banking. You transfer all your money in the offset account across on that day. And you change all your direct debits and all that sort of stuff. But it's not a big process. It's... And, I don't be loyal to any banks. We've all got things that we're tied to, but there's a cost of being loyal. And end of the day, every bank's just a different color in our books. Some have got better internet bankings, but some have got worse. But it doesn't mean you have to all your banking at that bank as well. I actually prefer that. So I personally do all my banking at ING for my personal. It's great when you travel as well, ATM fees and the international things that and I actually... ING are probably one of the most conservative banks, right? So I'm unlikely. I'm a bit more on the aggressive side, so I'm unlikely to use them on the lending point because they're more conservative. I go maybe to more the private banks and the retail banks. And so that's always good for me. I just do my day-to-day there. So I don't have to worry about changing my net and my binge and all my my regular payments. I can just move my mortgage really easily because there's not too much to change.
That's good. That's really helpful, Chris. So I do appreciate that. So I think there is a few steps there, but I really just want to double click on that refinancing because it's something I'm looking at doing. I would encourage everyone, if you haven't done it, especially in the past 2 or 3 years, your salary's probably gone up. even though your borrowing power may be damaged by interest rates going up, your salary's probably gone up, and you may have equity in your home because, like we just said at the top of the show, in all but one capital city, prices have gone up just in the past 12 months. Like, even though Victoria or Melbourne may have lagged Sydney and Perth the last year, the last 3 years, it's been a phenomenal place to have property. So chances are you might be sitting on something you've just not realized. At the same time, the bank has been creeping up your interest rate. And as Chris said, taking advantage of that. Now, we do have about 5 to 10 minutes for questions, Chris, and then we'll call it a day. And as always, you can write in your questions. No matter which podcast you listen to on the Rask Network, you can send in your questions. If you do want questions answered basically every week, property related, go and listen to the Australian Property Podcast. Regardless of where you're listening to this right now, go and listen to the Australian Property Podcast for all things property each and every week. There's 2 episodes a week. But we do answer questions because Chris and Pete and Amy and everyone else comes and shares their wisdom throughout the entire network. But there's a link in your podcast player that says ask a question. You can also use that to give us feedback. There's also a link there to get in touch with Chris and his team and to book a call. We do that all online. It's super seamless. It takes you probably a minute to book in a call. It doesn't cost you anything. You can just speak with the Flint team and just see if that's maybe something you want to explore. Now, obviously, we're going to answer these in a very generalized fashion. If you do need advice that is personalized, you should seek the advice of a trusted and licensed financial professional. We're going to try and stick to property rather than talk about the other stuff that goes on in your life, which is a bit more compliance-y on our end to deal with. So we're going to keep it to property. This first question was bloody long. And they even said at the bottom of it, sorry for the long question, but it is a good one. And it came through from Anonymous. I'm going to read the first bit, the middle bit, and then the end bit, so we all get it. They said, accountant, ? Broker, ? Advisor, ? No one seems to be the best person to speak to. Hi, Owen. I just listened to the recent podcast you did with Chris about buying your dream phone, and you put out a call for similar scenarios to discuss. I have one I'd love for you to talk about. My question is, do we sell my investment apartment to make life easier today, like repayments and whatever, if we know it's not a great decision long term? They go on to tell us a little bit about themselves. You know, they've got the primary residence, they've got a mortgage. They said they've got this property, they got some cash, but they said with $1.5 million in mortgages, most of it on our primary residence, and me wanting to stay part-time for a few years, selling the investment property would free up $300,000 that we could discharge off our principal place of residence and reduce our mortgage and make us a bit more comfortable. But in the long term, we have no investment property. I have spoken to my accountant, broker, property manager, and financial advisor, and all of them seem to point me to one another. No one seems willing to discuss this. I'd love for you to have a chat about this on the show and talk through the different options. So, Chris, I'm going to put it to you, but I'm also going to paraphrase. Bit of debt, primary residence, like good primary residence they live in, investment apartment. Some people get in that situation. It's a very common situation, actually. So talk to us about that.
Look, Anonymous, it's a great question. And what you have absolutely highlighted is in the world of advice around property, right? And, you know, because it's unregulated, that's another issue in it, is that the accountant wants to do the tax advice. The broker's just generally going to give you the mortgage advice of the pros and cons of selling. The financial advisor is not trained in property, right? Like, they are genuinely focused on shares, super, personal insurance, cash flow, etc. And property is just this, you know, elephant that they just don't, even though it's Australia's biggest asset. So you've kind of highlighted the issues where you get bounced around, right? Ultimately, there's a lot to think through here to decide what to do. Now, when I look at your situation, you've got an apartment, right? And if you do sell it, right, you are going to release up a bit of cash, right? And, you know, let's say it's a few $100,000. Well, what would you do with that money? Well, you'd put it into your offset on your mortgage, right? And so there's an instant, you can look at it as a cost of capital, right? So what am I making from the apartment? Not much, because my rent's not just basically covering my mortgage at the moment. And maybe I'm, you know, slightly positive cash flow. I'm slightly negative cash flow. So I'm not making much, but I'm not losing much, but I still own the asset, all right? But if they sold, they'd have $300,000 in their hand, which they could offset their mortgage, and under 6% interest rates, you'd save about $18,000 a year after tax. And so if this apartment over the next few years, while rates are high, isn't going up by, say, $30,000 a year, well, you're actually losing money, because you would have just been better having that money in the offset account. But that's a really short-term way to think about it. Now, if that apartment wasn't going up and it was a poor asset, well, then the opportunity cost is quite big, right? Now, having a quick squiz at this, knowing where it is, you might say, well, it's actually not a bad asset. It's in a low supply area. It's great, desirable for first home buyers. It's good for couples. It's good for young families. It's a great location in the suburb. I'm pretty confident on the growth of that long term. So why would I really want to sell it when it's a good asset and it's likely to grow? But if it's a poor asset, absolutely you'd want to sell it because there's a cost of having that equity there, which you could pay off your home loan. Look, another reason you might want to sell it is if you had no buffer. But looking at your situation, you've got a pretty big buffer, right? And so it's not like you're really struggling to pay the mortgages right now because you've got a big buffer. So that's another reason why you wouldn't sell. So that would be my gut take here, is that if you've got a good investment property, you can afford the cash flow, it's sort of, covering itself, and you're going to hold it long term, then, you might be better just to hold versus paying off your mortgage. Now, if what you really want to do, if you're ever going to sell something, even if you just think you want to sell it, it doesn't mean you should sell it today. Sometimes markets have got momentum behind them. Either way, they could have negative momentum or positive, but sometimes you want to try to capture that because you can get a bit of a short-term run-up in prices, and you might say, well, I do want to sell it long, I'm going to hold it for another 1 or 2 years. Try to basically capture that momentum and then get out and get a slightly better price. So, it's a great question. What's good about it is it just sort of shows the gap in the market where no one really wants to, give you that sort of practical advice because it's not really their main skill set.
Yeah. And we should say that we did get more information than we had in the question. We knew I wasn't Stanmore, and we knew that they do have a pretty secure job. Their profession is very secure. Yeah. So there was a bit more to that, but I think that's a really interesting thing. It's funny from a behavioral perspective. Some people I remember when I was in the army, Chris, I was like, once you're 10% out mentally, you're 90% out the door physically. And some people, I feel like they would do that with their finances too, where they begin to doubt and then they're already out the door. And they just need someone just to come in and just be like, hey, hold on a second. Let's just think about this. So the moral of that story for me is just work with people that actually care and want to actually sit down with you and want the best outcome for you. We've probably got time for a couple of quick ones. This is one from Marge Simpson, and this is the real Marge Simpson, I'm led to believe. So we can take that as given. What's the risk of my real estate agent acting as a dual agent for me and as a seller, and then acting for my buyer as well? Can a real estate agent do that, Chris? If so, any alarm bells and anything?
Oh, look, I don't really know what state it is. This is sort of down to real estate license laws, and I think it is state-based. Look, I obviously you got to be a bit careful here, right? Genuinely speaking, you want the seller the agent to be acting to you as the vendor. If they're also some type of buyer's agent as well, you've got to be really careful with that. It's really, you probably should be picking a better agent, one that doesn't work with buyers. I'd want to only work with a selling agent who's selling a lot and is too busy to worry about trying to do some buyer's agency on the side. Look, there has been this interesting thing where agencies are like, well, we're selling heaps of properties. Maybe we should start a buyer's agency as well, or we've got an in-house buyer specialist. I don't know. I think that's it's you pick the side of your fence that you're on and you just become the best at that. I think it's a bit rich to sort of then offer buyer's agency services in-house. They haven't genuinely worked, and so but I have seen that pop up more and more when I've looked at real estate websites. And so Marge, I think get an agent that's absolutely the best at selling, isn't worried about also helping buyers. Because you can see, obviously, there's a massive conflict of interest there where the buyer wants to get for the best price and the seller wants to get the best price. How are those two worlds going to meet? Someone's going to have to take the hit, right? Whereas the agent acting just for you is focused on one thing.
Yeah, a lot of agents have their own off-market list, which is a different thing, and sometimes they do have buyers already lined up. So that may just be the case in this. But the easiest thing to do, I think, in my 2 cents, is just to just get a second opinion or a third opinion. Go and speak to other real estate agents and see what they're pricing it up, knowing what their incentive is. So final question for you, Chris. We did have a couple more, but we've run out of time, and we will do more. We do these property Q&As over on the Property Pod every week, and we will be back here on the other channels in coming weeks as well. So keep your questions coming in, all property questions. Get in touch with Chris and his team. I'm going through the process at the moment. If you do get in touch with Flint Group, you can send me an email. You can jump into the Rask community, send me a direct message. Let me know what you think. Just let me know. Like Chris and I know, we'd love to hear from you. But the final question is, like, we go through this like hour-long podcast. We listen to these things every week. Clearly, property and people's mortgage is the number one thing that they can think about right now because it is the biggest, bulkiest thing in their personal P&L. What's one thing that you would really emphasize for people to take away with this episode and to do right now?
God, you put me on the spot here, Owen. This is a big question. Look, on your mortgage, get in contact with your bank, your broker, and just be really on top of that. And if you are under financial stress, don't shy away from it. Don't start missing repayments. Don't start not speaking to the bank. You start to really create issues for yourself. And if you're getting yourself into that position, speak to the bank, speak to your broker. They will do things that will help you. So if you're in that financial stress situation, you might be able to buy yourself some time with a payment holiday or interest only or something. They will want to work with you. So don't just rush to sell because, you know, the people who maybe rushed to sell 1 or 2 years ago when rates started going up, you know, they're not going to be happy right now, are they? Yeah, they're in a rent and they can't buy the property they sold because it's actually gone up in value, even in the face of everything that's happened. So I'll be a bit mortgage advice 101 is just stay on top of it and really just, you know, try to get yourself in a better financial position there and build buffers even if you aren't stressed. Around property, etc., is just really understand the big macro fundamentals and then what drives prices at a local level. Like really educate yourself and don't make the easy option and don't just, for example, rush out and buy something or, you know, try to follow some investment sort of, hotspot or anything like that. If you're going to buy investments, buy long-term. Be very careful buying in markets that have also grown really strongly in the past few years, because a lot of that growth does happen in cycles. And if you're coming late to the party, your risk is higher and your returns are going to be lower. It's just natural economics. And so be a bit careful with investing at the moment and buying longer term always. And if you're in a really strong financial position, maybe it's a good time to transact. Because ultimately demand is lower right now because rates are higher and borrowing capacities are tight. But if you're in a very fortunate position, but maybe you didn't leverage up and maybe work's doing much better and maybe you got some inheritance and you're in a really good position, then maybe you don't want to potentially wait when the mass market comes back into the market when rates are lower, borrowing capacities are higher, FOMO's more in, the momentum's behind the market. That's a market you hate to transact in. It's really hard to buy good assets because you have to pay a massive premium. And so if you're in that strong position, don't, just assume that's going to continue and get better. Maybe it's better to just be in the market watching and waiting for a good asset now.
Love it. So on the one hand, if you are struggling, if you are on the brink, go and get in contact with your bank or your broker. Tell them, stick your head above the water for a second, catch your breath, speak to someone. It will help you, even just emotionally and strategy-wise, that will help you. And if you're on the other side and you're thinking, well, maybe now's the time for me to go on the offensive because I've done a lot of things, I've cut my costs, I've increased my wage, get in contact with the right people or go and do that yourself right now. And that would be my big takeaway. So Chris, thank you so much for doing this. Wish you all the best with the Flint Group stuff. It's amazing to see you guys taking strides, more people in the Rask community going to Flint and getting mortgages. It's amazing. So once again, mate, thanks for joining me.
Thanks so much, Owen. We'll talk soon. Thanks for listening.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.